Of course, our income strategy has had a remarkable first half of the year. So now let's just talk about from a big picture perspective, from a portfolio perspective. How are you thinking about portfolio positioning, specifically with respect to interest rate risk, credit risk, and FX risk?
Yeah, let me start with the philosophy. I mentioned today a more uncertain world, more volatility, less synchronized cycles, more political uncertainty, and very elevated equity valuations from a historical perspective, and quite tight credit spreads from a historical perspective. So the market is optimistic, and therefore, what we're trying to do across this very flexible portfolio is to find ways to generate attractive yields and generate attractive yields relative to other strategies out there in the market that have a lot more economic sensitivity that would be much more exposed to drawdowns if we were to get into a period of more sustained economic slowing or other factors were to crop up that led to some fear in markets. So what we're trying to do today is to generate an attractive yield, but also provide resiliency. That's been a theme we've talked about now for several quarters. It's a theme that we believe is pretty important and is a key differentiator of the strategy over the course of the next couple of years in this highly uncertain environment. So that's one point. The second point is that we're really focused on the fact now that after the significant sell-off in rates that we had over the last few years, starting yields, either nominal yields or inflation-adjusted yields, are attractive from a global perspective. They're particularly attractive in many cases when hedged back to the US dollar, at least in terms of the primary currency exposure. And they look attractive again in a historical context. So, yeah, there's going to be a lot of noise. Yes, there's a lot of near-term economic uncertainty, policy uncertainty, but starting yields are quite attractive. So again, today, certainly relative to where we were back at the end of 2021 as an example, we have more interest rate risk. We've locked in some of these higher yields for a longer period of time relative to the cash rate. And again, this diversified high-quality interest rate exposure has served us well, to your point, in terms of performance year to date, but also going back over the last 12 months or so. I think that's a really great example of how high starting yields can be a significant ballast to a portfolio. They can provide a significant resiliency in terms of return. So we remain optimistic, not only in terms of the yield component of the strategy, but also the ability to generate incremental return or alpha